You just got a $3,000 raise. Your boss congratulated you. HR sent the paperwork. You did the math in your head and figured that's $250 extra every month. But 3 months later, you're looking at your bank account wondering where that money actually went. Your checking balance looks almost identical to before. This happens to millions of Americans every single year. And it's not a mistake. Here's what most people don't realize about raises. When you earn more money, you don't just pay more taxes. You might move into a higher tax bracket. Let's say you were making $55,000 and now you're making $58,000. That extra $3,000 might push part of your income into the 22% federal tax bracket instead of 12%. This is called marginal tax rate. Only the dollars above the bracket threshold get taxed at the higher rate, not your entire salary. But it still means Uncle Sam takes a bigger bite of that raise than you expected. According to payroll data from ADP, the average American keeps about 60 to 70 cents of every dollar from a raise after all deductions. That $3,000 raise? You're probably taking home around $2,100 for the entire year. That breaks down to $175 per month, not the $250 you calculated. This is why your bank account barely budged. The difference between gross and net income becomes much more obvious when your salary changes. Taxes aren't the only thing that increases. Many payroll deductions are calculated as a percentage of your salary. Your Social Security contribution is 6.2% of your gross pay. Medicare is 1.45%. If you contribute to a 401k, that's probably a percentage too. Maybe you're putting in 6% of your salary. When your salary goes up, all these percentage-based deductions automatically increase. A $3,000 raise means an extra $186 goes to Social Security alone. Then there's Medicare, retirement contributions, maybe HSA contributions if you have a high deductible health plan. These add up fast. Let's walk through a real example. Sarah makes $55,000 in Texas, which has no state income tax. She gets a $3,000 raise to $58,000. Federal income tax takes about 22% of that extra $3,000, which is $660. Social Security and Medicare together take 7.65%, another $230. Her 6% 401k contribution takes $180. Total deductions on that $3,000 raise, around $1,070. Her actual annual increase in take-home pay, about $1,930, or $160 per month. Here's another factor people forget. Many raises happen at the start of the year during annual reviews. January is also when lots of benefit costs reset. Your health insurance premium might increase. Your company might have raised the cost of dental or vision coverage. If you have flexible spending accounts, those reset annually and come out of each paycheck. The parking pass fee might have gone up. All these annual increases hit your paycheck at the exact same time as your raise. So you're comparing your new higher salary to last December's paycheck, not to what January's paycheck would have been without the raise. If you live in a state with income tax, that raise gets hit even harder. California's top marginal rate is 13.3%. New York is 10.9%. New Jersey is 10.75%. Someone in California getting a $5,000 raise might only see an extra $225 per month in their bank account after federal taxes, state taxes, and all other deductions. In states with no income tax like Texas, Florida, or Washington, you keep more of your raise, but you're still losing at least 30% to federal taxes and payroll deductions. Even after accounting for all the deductions, there's one more reason your raise disappears: lifestyle inflation. This is when your spending quietly increases to match your new income. You start ordering lunch more often because you're making more money. You upgrade your streaming subscriptions. You buy the nicer coffee. Each decision feels small, but they add up to exactly the amount of your raise. Research from the Federal Reserve shows that household spending typically increases 70 to 90 cents for every dollar of income increase. Your brain treats the raise as permission to spend more, even when you're not consciously making that decision. Here's how it happens without you noticing. You got your raise in January. By March, you've added a $15 meditation app because you can afford it now. In April, you upgrade your Spotify to the family plan for another $8 a month. You start getting takeout one extra night per week. That's roughly $60 monthly. You replace your old gym with a nicer one for $20 more per month. None of these feel significant. Together, they're $103 every single month. Your $160 monthly raise just became $57. 26% of Americans who get a raise immediately increase their debt payments, according to a study by Northwestern Mutual. This sounds financially responsible, and it can be. But it also explains why your checking account balance doesn't look different. If you took that extra $150 per month and put it straight toward your student loans or credit card, your monthly spending money stayed exactly the same. Your net worth is improving, but your daily financial stress level hasn't changed because your available cash didn't increase. There's also a psychological timing issue. Most raises are calculated annually, but you experience your financial life monthly or even daily. A $3,000 raise sounds substantial as a single number, but $160 per month feels much smaller. That's about $5 per day. Your brain doesn't perceive $5 a day as life-changing money. And when you're buying a $7 lunch, that daily $5 increase literally disappears into a single meal. The way we think about money in different time frames makes raises feel less significant than they mathematically are. So what really happened with that raise? The money didn't vanish into thin air. A chunk went to taxes at various levels. Another portion went to Social Security and Medicare. Your retirement account got more funding if you contribute a percentage. Health insurance and other benefits took their share. Then lifestyle inflation absorbed whatever was left over. None of this means raises are worthless. Your retirement account is growing faster. You're paying more into Social Security, which increases your future benefits. You might be paying down debt. These are real improvements to your financial situation. They just don't feel like improvements in your monthly cash flow. To sum up what we covered, your raise increases your tax burden because of marginal tax brackets. Percentage-based deductions like Social Security and retirement contributions grow with your income. Annual benefit cost increases often coincide with raise timing. Lifestyle inflation causes spending to rise alongside income. The psychological perception of a raise differs dramatically depending on whether you think about it annually, monthly, or daily. And finally, raises still improve your financial position even when they don't improve your monthly cash flow. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.